And performance is based on performance is just the reason as to why you are currently working at your job place. You know that the organizations normally monitor and checks your performance within the organizations, and therefore the reward is based on how we are performing. Um, so we are going to be having some performance measurement that you're going to be checking on, and the organizations will be able to achieve their objective because of the budget which is already set aside by the organization to make sure that the people or the employees are able to match the expectations. Now, that is where we are saying that we normally have vision and missions where we are discussing about the short and long-term goals that are normally set under the effort of the business segments, and therefore the food stuff will be divided into the goals. Remember, not everybody will be employed within the organization who can be able to do all the duties, and that is where we are going to be subdividing the employees based on their qualifications. So that is why we are saying that the main objective of the management control is to encourage goal concurrence, which means that if the people want to achieve their own goals or the objectives, they also have to achieve the goals of the company as a whole. So that is why we say that the personal goals matches with the organizational goals, and that is why we go hand to hand with the organization's objectives. So we are seeing the main reason for aligning these objectives to ensure that there is harmony in the organization, and we are saying that to accomplish these objectives, the managers will be able to assign responsibilities and develop performance evaluation methods that motivate the employees toward the company objectives. I will be able to give you very simple things that organizations normally do. At the end of the year, you could see that organization try to reward the best performing employee. And this normally set a bar within the organization to ensure that the employees will be committed to their duties. They are disciplined. They will be able to maintain ethics, and they will be able to achieve the goals which are set by the organizations. Now, we are saying that the first step of implementing responsibility accounting is to establish the responsibility control, which will be able to include the following. So we are going to be having certain centers with which we can be able to measure performance. We are going to be discussing about the cost centers, and we are saying this is a section of the organization which incur the cost but does not generate any revenue. So the manager is responsible for the cost incurred in the section. So performance measurement is done using the cost variance. And you remember when we discuss about the variance analysis, which is a topic that we shall be covering pale kwa budgeting and budgetary control. We are going to be looking on the organization's budgets, and these budgets that we normally analyze, we have to be flexing. And when you do a flexible budget, it means you're going to be matching the expected with the actual performance. So that is where we are utilizing to check whether that can be achieved. Number two, we have to be looking on the variances which are existing from what we budgeted and the actual. In this case, I'm just discussing about if, for example, you allocate 50 shillings to go out there to buy. Let me talk about chapati. And when you enter to a certain hotel, you find that the chapati is costing 100 shillings. So there is a variance of 50, which is adverse, and that is a cost center, which the managers will be able to look on the performance measurement in that aspect. Now, when you look on to access performance objectivity, the cost should be controlled by the manager, like the production department. When you look on the production department, and I think the people who work on the manufacturing sector are lucky in accounting perspective, because majority of the students, the majority of the employees normally understand more about what they are expecting from the organizations, and therefore we have to be checking how the people who are working within the production departments How are they incurring this cost? And that is the best thing to achieve, to monitor the movement of goods within the production department. And if you did a good, when you did the main, the lower one, we used to have a cost bookkeeping where we used to analyze the double entry, and the same topic is tackled on FA, financial accounting. So this is the aspects, or is a pure accounting where we have to be looking at double entry. So if I want to buy goods, I have to go to the bank, I withdraw certain amount, I go to the market, I purchase, and then the item which I'm purchasing, I have to open the stores. That is a double entry. You credit here, you debit there, and that movement continues within the organization. So that is the aspect of the cost centers, purely accounting. Now, when you look on the revenue centers, we are saying it is a section of an organization which generates revenue but does not incur the cost of production. And these are the sales department. Wale watu wanauza, they don't know how hard it is to make those products. They just have to ask, how many products do we have? And then they are going to be doing scorecards within the stores to be able to monitor the movement of in and out of the product. Now, the production department is the one which already carries the organization, because they will be able to satisfy. They produce the product which already matches the customer's perspective of the customer's preferences. When you look on the profit center, we are saying it is a section, in this section, the management is responsible for the revenue generated in the section and the cost of production. So we are saying the performance is measured using the profit related measurements. And in this case, we have to be looking on the net profit margin. And for instance, if you have done comparative statements, you have to be looking on the performance measurements, where we have to be looking how the company performed in the previous year compared to the current year. That is the aspect where we normally calculate the proportions, and the proportions calculated normally assist us to understand how the growth or the attainability of the goals set by the organization are being achieved. Now, when you look on the investment center, we are saying it is in this section, the manager has additional responsibility of making investment decisions. And I know majority of us, we normally prepare financial statement, that is for sure. And the financial statement prepared, we have to be gathering, it is just a form of gathering information that we are saying the information which is gathered here will be good for the decision making. So that is why when we are doing the decision theory we discussed about, the accountants are required to provide the right information at the right time to the right people for the decision making. And therefore, if the organization has made certain profits, we have to be checking on the reported profits, right? What is our reported profit? And I find that majority of organizations, after they report a profit, they normally have to check on they normally do this. They normally retain certain proportion for investment for purposes, and then they normally payout, where we normally discuss about the payout ratios. So that is the aspect of the investment. The amount that we normally retain within the organization, it is basically used for investment purposes. So that is where we are right now, the investment center, where we are saying acquiring non-assets and non-current assets and other investments. Some of the organizations, they might not be having issues to do with they might not having problems with the assets, and therefore the assets based on the type of the business in which they're operating, and therefore they may decide to go for the long-term investment. They purchase loans, they just go to the CBK, they open CDs accounts, and then they start trading for bonds. Other organizations may decide to reinvest based on research and development of the product in which they want to produce. And those are the steps that you are going to be checking on the areas in which the organization can do when we are doing the pricing. Remember, in the life cycle costing, that is the thing we normally do. We have to be looking on what are the costs in which we have to incur, and we have to be looking on the research and management as the first aspect, where we have to be knowing what do we require, what are our customer demanding, and so on. So that is why we are saying responsibility accounting is very important, especially for a decentralized organization. And we are saying decentralization is the distribution of the decision-making power to different levels of the management in the organization. So we are saying the most important way of decentralization is divisionalization. And in this case, we are saying when decision-making power is given to divisional managers. I like it. I like it. And within the organization, I don't like where I'm the only person who is making the decisions. I like when you delegate the duties for decision making. You find that if it is a production department, they have their head who will be making the decision on behalf of the others. If we are discussing about the dispatch team, there is someone who is going to be making the decision, and then this person will be reporting back to the manager to be updating on what is happening to that department. If we are discussing about the transport team, for example, you find that most of the organizers they give toll to the riders and so on. So those are the things that you need to delegate. Don't always look on the someone. For example, if you have 100 riders, don't always like them, all of them reporting the problems to you. Just appoint only one person, right? That decentralize. You are trying to decentralize the decision making within the organization. Now, if, for example, we are discussing an organization which is having branches, we have to be looking on now, the branch managers will be making the independent decisions, which will not be influenced by the decision of the head office. That is the thing of decentralization. I think I have able to give you what is the disadvantage. But when you look on the disadvantages, in case of disagreements on the certain policies in which each team wants to make, you find there is a lack of harmony, and we are saying the decision managers may act independently to pursue their own goal to the detriment of the company's goals. It increases the cost of information because the organization will be able or will require to elaborate system of control to output information for the purpose of monitoring. But due to this problem of decentralizations, most of the organizations are using powerful systems like ERP, which are assisting us to collect the data from our branches. Once installed, it is just integrated. The system is just integrated to be able to match what? To match the expectations of the organization. Now, it may result to duplication of the duties, and that is for sure. The top management may choose to control, especially where the decentralization is excessive. That is, doesn't have any problem with that. So we are saying decision manager may make poor decision on investment, which may affect the overall performance of the company. So those are the advantages, disadvantages. Mostly they are tested. That is a theoretical aspect. The examiner will be able to ask you those questions. But we are saying this, when you look on the divisional performance measures, we are saying in a decentralized organization, divisional performance need to be evaluated. And there are two types of performance. We have to be checking on the managerial performance, and which is basically vested to the branch managers. And then we have economic performance, where we are going to be monitoring the aspect of entity, where we are going to be looking on the performance, where it is not based on the manager, but is based on the division. So that is where we are looking on the two aspects. So when I take you through the managerial performance, we are saying this is the performance of the divisional managers as an individual. A manager might have an excellent performance record, but the condition the division affect the performance. And that is for sure. You normally find that you have zeal to execute your duties within a certain environment, but your colleagues are the ones which are letting you down. The decisions or the performance evaluation, when it is going to be done, it will be based on the branch, but not on individual aspects. So that is one of the managerial issues that we have. But we are saying when we evaluating the division of performance, the items which are controlled by managers should be taken into account. The others should be ignored. But when you look on the economic performance, I think this is the area where you are much attached to. We are saying the performance of a division is an entity devoid of its managers. The performance is evaluated based on the division and not the managers. And our interest is determined by the managerial performance when measuring the performance of a division. We use the following measure. Sometimes we use the return on investment, others we can use the residue income, and then we have the evaluated economic value added. Majority of us, we tend not to understand what is the return on investment. What is the return on investment? Today, I put 2.7 million to a SACCO, and at the end of the year, I'm expecting some dividend. Remember, I put this money to investment, a fixed deposit account, or I have purchased their shares. What am I expecting at the end of the year if the company is reporting profit? That is the return on investment. What am I waiting? And sometimes the examiner can use the cost of capital. You remember that those are some of the terms in which they use. Number two, we can discuss about the residue income. I think you have them here. And the residue income, we are saying, it is the amount left after the providers of the capital have left. It is the profit that will remain within the organization firm after paying the providers of the capital. I will be able to elaborate it in this way, that the residue income I treat it as the retained earnings, because the retained earnings, this is amount which already is vested within the organization. That is what we are going to be remaining with within the organization, and therefore we don't tend to have any issues with it. So we are saying that let me take you through the return on investment very quickly. And we say that it is a measure used to compare the profit and the capital employed. And the profit in this case should be valuable profit, the profit that can be controlled within the organization. So the capital employed should be the net book value of the asset. That is the return on investment. So we are looking at the division of profit. We divide by the net book value of the asset, then we multiply by 100%. But we are saying the NB, the value of the asset should be at the beginning of the year unless otherwise stated. The value of the asset will be at the beginning of the year. Tutakuwa tunaambiwa that thing. But sometimes we tend to forget what the conditions normally provide. The amount will be at the beginning of the year. So when I'm calculating the net book value of the asset, some students tend to ask me, why are we talking about, why is our format looking that it is a must I have the beginning? It is, you see, it is a condition. Now, when I look on the advantages of the return on investment, I'm saying it is a relative measure and therefore enables comparison of the divisions with different sizes, with different investment. It can be broken down into secondary ratio for future. But when you look on the disadvantages are there, you shall be able to look on them. And then later you check the advantages and disadvantages for residue income. But we had been told that to get the residue income, this is the amount left by the providers of the capital. It is the profit that will remain within the organization firm after paying the providers of the capital. But we normally look on the division of profit, we subtract the cost of capital. That is the thing that I have already stated. Now, before we come to the ever, I just want to tackle the first two. And I just want to start by doing the question which was tested last semester. I think we are casualty for that, and but I'm not expecting ourselves to be on the same again. So in this case, let us look on the question here. The question for that matter, for 2022, years are moving very fast. So tumeanza kuzeeka. We have to accept the realities now. Great. So when you look on this question, it was very simple. I don't know how it could trick. I don't know whether you got it. Ama was the only question that you got. Mambo ni mingi kweli. Now, but your paper was very good. Very good. Very good. We are praying God to provide another paper like this. A very amazing paper. Actually, we are doing all these questions today. All these questions. Stay tuned. You see, there is a limiting factor analysis. That is the short-term planning and decision making. That is our next stage. That is our next stage. Now, there is this question which was tested here. I know the biggest problem that my students are having is this question, which is still clicking on their mind about this kind of variances which were brought in the exams, but never worry. The solutions are always there. Now, there is a transfer pricing question. I don't know whether Robert was able to do it, but it is a copy pasting question. And then we do the good flexible budget. We shall be able to achieve our target of doing the whole of these paper. Now, let me get back to business. And I see we had 8 marks for free. And then we were being told to state which method of performance evaluation would be more useful when comparing divisional performance and why. 2 marks. The question was 10. Remember, advanced level, I told you, is very difficult. And it needs a lot of practice. I know that because already we shall scare the outcome, it is good to put a lot of effort to achieve the target. The paper is very dangerous, by the way. Management accounting is not a joke. So let me get back here. I will be able to give you a lot of speech later. So we are saying that Majimbo Limited has 2 division A and B, whose respective performance under review. Division A is currently earning a profit of 35 million, while Division B and at a net assets of 150 million. But we have been told in Division B, which currently earns how much? 70 million with a net asset of 3.5 million. Now, the question which they are asking here, we have been told that the Majimbos Limited has a current cost of capital. They have a minute, please. The cost of capital we have been told is how much? We have been told is 15%. Now, using the information above, we have been told calculate the return on investment and the residue income for each of the 2 divisions and review and comment on your results. So that is the thing that we are doing straight away. And I will be able to tell you that these questions of the performance measurement, wakati umefungua tu swali hivi, umepata una swali ya performance measurement, believe you me, they are giving you 8 marks theory, right? Every time you open your past paper and you find that hakuna swali yeyote inahusiana na performance measurement, believe you me, they are going to be asking you 6 to 4 the 4 marks question. Now, I want to start by calculating the return on investment, and I just want to rush to my board to look on what is happening there and look on whether I can get some solution. In this case, let us move on. Let us move there. Let us move there. I think everyone has the past paper, and we are having our calculator standby. I don't want today to have a lot of delays. Questions when I ask the answer, because also you have given me a duty to give you solution for these questions. I need the answers because I have to be showing you the way. So we are talking about April question. April, we are discussing about April 2022, question 3A. Question 3A, very simple question. Number 1, I would just want you to be able to write your formulas, right? You don't need to be having to struggle a lot. For example, if I talk about residue income, unaniambia tu vizuri. We normally take the divisional profits. Then we subtract the cost of capital. The cost of capital, just like that. Divisional profits, you subtract the cost of capital. I will be able to show you how to do it. Then the other one, we are talking about return on investment, where we talk about our divisional profits. We divide by the net book value, by the way. Then we multiply by 100%. We multiply by 100%. I just want to start with division 1. Someone to tell me that he is seeing my board. Division A. So in division A, we have to be looking on the problems which the examiners created there. And we have just been told that the Majimbo Limited is operating 2 divisions. A division A is currently earning a profit of 35 million. So If I want to calculate residue income, let me start with the residue income. I have said I take the divisional profit, which you have been told is 35. Let me limit my values to millions. So it will be 35 minus, you take the cost of capital, you multiply by the cost of investment. I see here the examiner has given us the cost of investment because sorry, not the cost of investment, but the net assets. The division is currently earning a profit of 35 million and that a net asset of 150. So look at where we have the cost of capital. The examiner has given us 15%. So 15% of 150. So how much is that in Kenya shillings? How much is that in Kenya shillings? How much is that in Kenya shillings? How much? How much? Then we go to division B. We do the same. Division B, we do the same. Someone to give me the answer. Then we have the return on investment. We are going to be taking, when I look at division B, we are being told the divisional profit is 70 minus 15%. We multiply by 15%. We multiply by 325, which is our net assets. And someone should be giving me the return. Ningapi? The first one? 12.5. So I just write here 12.5 million. The second one? The second one?
21.25.
21.25. Very good. 21.25 million. Imagine. That is what the examiner anataka nifanye. Ambiwa mambo ni ngumu. Now let us go to the return on investment. We have said we have to be taking divisional profits. Divisional profits. We divide by net book value. And they are supposed to be in percentages. So in this case, we start with division A. So the divisional profit of ours is 35. Divide by the net book value, which is equivalent to 150 times 100%. And then we have our B here, where we are discussing about 70. You divide by 325 times 100%. How much is this in percentage? In percentage. The first one is let's be very quick. Very good. Very good.
23.33.
23.32. Very good. The first one, I think.
0.33.
0.33.
Okay. The second one.
21.54.
21.54%. Robert, you did like that?
Exactly.
I don't know. So let us look on the project that is giving the return on investment. This has a higher, but when you look on the residue income, it has the lower residue income. You just need to say this. Division A has a higher return on investment, right? But a lower residue income, which is vice versa. For division B. Which is vice versa for division. That is what the examiner required. Just do it like that. I have 8 marks. 8 marks for free. Then number 2, we are being told, state which method of performance evaluation between the return on investment and the residue income would be more useful when comparing divisional performance and why. And you say this. Let me wrap this side so that I can give you the correct answer for that. So let me say this. I've been told that to compare between the two, this is part 2. So to compare between the two, we are just being told, we just say this, return on investment. Return on investment would be the better measure when comparing, will be a better measure when comparing divisions. Since will be a better measure comparing divisions, as it is a relative measure. That is why I'm stating as y, right? This is a relative measure. As opposed to residue income, right? Which is an absolute measure. Which is an absolute measure. Therefore, has a size of divisions problems. Therefore, it has size of divisions problems. Division problems. That is how we solve these problems. Another question, a quick one. I just want to look on May 2018. May 2018, question number 5A. Let us look on other question which were tested and it was giving out remarks. Another question. May 2018. May 2018, question number 5A. May 2018, question 5A. Great. So in this case, we just say May 2018. I said, if you practice all the questions that I do in class, you will never fail. You can't fail exam unless now kuna shida ingine. Unless kuna shida ingine. I do a lot of questions, by the way. I don't know whether nilikufanyia hiyo ya sofa. Nimeona swali ya sofa somewhere, this one. Did we do ABC? Tulifanya ABC limited? ABC, sorry, activity-based costing?
No.
No problem. Now, question 5A. We have been told SEC Limited has 2 divisions, namely B and C, each under a divisional manager. The 2 divisions plan to acquire some investment in the month of August 2018. Additional information, I think you are seeing everything. We have been told the cost of capital for both is 13%. The current return on investment is 15%. The divisions planned investment are the following features. We are being given the profits. We are being given the capital required for investment, which is 800,000. And then the revenue generated by the investment we are being given there. And then we have the net profit margin, given. So the question that we are being asked here is to calculate what? The residue, the return on investment. And also we are discussing about the return on investment. So how am I going to be doing my question here? I mean very well, when I'm given this question, what I'm supposed to be doing, the first step is to write my formula. Very simple. Very simple. I just say, to write my formula here, we are being told about the return on investment. I talk about divisional profits. Divisional profits, that is my first step, minus cost of capital. Cost of capital, right? So in this case, let me start with B and C, because that is what we are being required. Do we have the divisional profit? We say no. But the examiner has already given me the profit margin. I can be able to get my profit. So how am I going to be doing it? I can see straight away here, the examiner is saying that the capital required for the investment is 800,000, 400,000 respectively, but there is a revenue generated, right? So through the net profit margin, I can be able to get the divisional profit. So like the first one, we have 30%. Someone should be giving me the answer, that percent times the revenue generated, so that we can be able to get the divisional profit. So we multiply by 450, multiply by 450. The other one we are supposed to be multiplied by 210. 210. So divisional profit ya kwanza ni ngapi? Divisional profit ya pili ni ngapi? Divisional profit ya pili ni ngapi? Ya kwanza ni ngapi? 12, 13. 133? 130 ngapi? 135? Umelala sasa. 135,000. The second one is
73,500.
73,500. 73,500. 73,500. So in this case, you say, let me get the return on investment for B. You take the divisional profit, 135,000. You divide by divisional profit, the net assets, the net book value. In this case, will be the cost of investment, because there we are being given the capital required for the investment. We are being given how much? 800,000 in that first case.
Residual income.
Minus the cost of capital. The cost of capital of ours is, the current return on investment is the cost of capital for both is 13%. So it will be 13 of 800,000. Then the for C, it will be 73,500 minus 13% times Z 400,000. How much are we getting there? How much are we getting? Then we have our return on investment. We are talking about divisional profit. Divisional profit, we divide by net book value times 100%. So for B, the divisional is how much? 135,000. Net book value yako ni ngapi? 800,000 times 100%. And then we have for C, where we have to be taking 73,500. We divide by how much? 400,000 times 100%. Purity, give me the answers for the residue income. Umepata ngapi?
31,000.
31,000. The second one?
21,500.
Kenya shillings, 21,500. Good. That is already done. Then for the return on investment, Robert. There is a lot of pressure here, but we shall overcome, I think so.
16.
So how much is here?
16.88.
16.88.
Yes, and 18.38.
15.3.
No, 18.38.
18.38%. 18.38%. That is for sure. Wacha nikuonyesha lingine wanashindanga hapo wamekopi. Let me kuonyesha another question now. Wanashindanga wamekukopia hapa.
Wait a minute.
I'm very fast.
Malibu, wait. Mr. Vimy.
Jungle pressure.
You may continue.
September 2021, question number 1C. Patane pale, September 2021. No problem, wacha tufunze society. Tukikufunza utawafunza. No problem. CPA should be taught to everyone. Kila mtu anapaswa, actually inapaswa kuwa mandatory.
Nataka kuandika.
September 2021. Don't worry, to me that the children loves you so much. Now, hey. Oops. Mine is already with me. Question number 1C. Hii swali wana copy paste yanga to the way it is, and I will show you how powerful this topic is. Can you be able to see it? Very much, very powerful, very powerful. Can you look from number 1? Required question 1A. What is a responsibility accounting? Explain 4 advantages of responsibility. And then number C, unapewa swali 20. Ushapita. Ushapita mtihani. Very powerful. Very powerful. Someone to read for us, please. Someone to read for us. Purity jitolee tu. Tuje kuona for some time.
The division managers of the.
Yes.
I'm reading.
Yes.
The divisional managers of Lengaju Limited, a medium-sized company, are usually evaluated and those with outstanding performance rewards on an annual basis. The divisional manager of KT division is faced with the following mutually exclusive investments. There's Project A and Project B, initial capital outlay, and the net cash flows for 2022, 2023, 2024, and 2025. Additional information, the initial capital outlay is to be amortized evenly over the project's lives. The initial outlay is to be made on 1st January 2022. The company's required rate of return is about the year. Assets are valued at the net book value at the beginning of each year. Sorry?
Continue.
May I continue?
Yes.
Number 5, assets are valued at net book value at the beginning of each year in determining the divisional returns. Both projects A and B are expected to have nil residual value. Ignore taxation. You are required using the average revise the management on the project to select. Number 2, determining the average return on investment. Advise the management on which project to select.
Very good. Thank you so much. So the question has already been brought to you there, and they have given you a lot of marks. What can you do with this question when you find it in an exam? Now, in this question, I will just be categorical and say, give me a minute, please. 1 minute. Someone did not remind me I'm not recording. That means ever is not captured. But we shall overcome. We don't have the answers? What are the answers here?
$49.1.
49.1, correct? For the first one. The second one?
$52.45.
52.4.
Yes.
52.4, that is what you have said, and is the correct answer. Any questions so far? Any question? So let us switch gears to let us switch our attention from this area, which I think it is already covered and well tackled. I just want to go to we correct, we are here. So just want now to come back here to short-term planning and decision making. Short-term planning and decision making. Short-term planning and decision making. Short-term. So the name always telling us what we have to be doing. This topic is connecting us so much to lower level, section 4 right now. So in this case, the short-term planning is going to be giving us a, we are going to rewind what we did in section 4. I think now we are doing very much better. Even compared to last semester, the syllabus is covered, being covered early, compared even to last semester. And I'm expecting to have a good performance. So I just want to look on the short-term planning. Another targeted short-term planning and decision making. Have you taken water? Anyone who has taken water? Nobody? No. Now, when we discuss about the short term, we are saying that these are the short term planning, where we are setting smaller intermediate milestones to achieve within a shorter time frames while moving toward an important overall goal. Now, we are saying the short-term planning looks at the characteristics of the company in the present and the developed strategy for improving them. So decision is the thought process of selecting a logical choice from the available options. To make such decisions, we are going to be using two models. We normally have the cost volume profit analysis. Then we have the marginal cost analysis, where we normally look on the applications. So the application for marginal costing, I remember you are able to look on them at section 4. We used to have limiting factor. We used to have special orders, relevant costing, make or buy decision, and discontinuation of the product line. Those are the things that we did at lower level. And I want us to look on the broader areas about the application of the marginal costing up to the throughput. By the way, throughput is already part of the application, and it was tested, so we have to be making a lot of consideration to it. Now we are saying these models are are normally applicable, depending, it should not be and, but are normally applicable depending on the environment in which the decisions are made. Now, when you look on the cost volume profit analysis, I like to analyze it in this way. To determine the profit in which you want to report, you have to be looking on the volume that you have to produce. And also due to the limitations or the scarce resources, then the cost will be limited. You cannot be able to match the expectations or the demand. So the cost is the one that is going to be determining how much to produce and the profit that we can be able to achieve during that current financial year. Now we are saying to use many of the principles of marginal cost plus that marginal cost plus that's important in the short-term planning, and we are saying to explore the relationship between the three levels and the resulting profits. But we normally have some assumptions here, and when you look on the assumptions, we are saying all the units produced are sold, no opening nor closing stocks. The model relates to one product, and in case of the multiple product now. This, when you look on the one product, you never see that in section in your section. When you look on last semester's question, they brought a multiple product question, which was already well tackled here. Now we are saying that the multiple product is the kind of the question that you can be able to find at that level. And then we are going to be doing some sales mix in constant, which are normally constant and maintained. When you look on the technology production methods, and the efficiency level will always remain constant or unchanged. And then we are saying that the volume is the only driver to cost and revenue, only factor affecting the cost and revenue. So fixed costs remain constant with the relevant range, or the cost encounter are either fixed or variable. I want to be able to analyze all of these very fast. Very fast. Very fast. Now, let me analyze it here.
Ngoja kidogo hizo assumptions. Sawa. Sawa. Mwalimu.
So let's continue. I want to look on the functions under the CVP, which we normally do, that we have to understand. So let me look on them. So the functions, when you look on the functions, we normally have how many functions? Functions under CVP. So number one, we normally have profit function. Sorry, let us start with the revenue function. So it is noted by R. And we normally say to get our R, we normally take the price and quantity. So in this case, our P, which is our selling price, and then our Q, which is the number of units sold. Number of units sold. Then we have our Q, sorry, number two, we have the total cost function. Total cost function. And we are saying that it is denoted by TC. And we say to get our TC, we take what? To get our TC, we are going to be taking the fixed plus variable costs. And we say our F is equal to the total fixed cost. Hizi ni vitu ulifunzwa huko chini zote. Total fixed cost. V is equal to the variable cost per unit. Per unit. The variable cost per unit. And then the Q, these are the number of units. Number of units produced. Yangu nasikia ikataa kufunza, I don't know why. Number three, we have profit function. Profit function, which is denoted by this sign. So remember the lower level you used to say to get your profits, you take the total revenue minus the total cost. This is what you have been learning all through. But now at advanced level, we say, let us take contribution margin X minus fixed, right? And we say, where our CM is equal to the contribution margin, we talk about our X, and we say these are the number of units sold. Usiniambia they are produced because you are generating your contribution margin. Then we have our F where we are discussing about total fixed cost. Total fixed cost in that manner. Total fixed cost. Now from here, we are going to be looking on the break-even point. Break-even point. And we say, another break-even point, we say this. This is a point where the total revenue is equal to the total cost.
Mwalimu, you are fast and you're also blocking.
Okay, sorry.
Yeah.
That is what I have right now. I have said that that break-even point, it is a point where the total revenue is equal to the total costs. The total costs, right? So it means my profit should be equal to 0. So the examiner here normally has the number of units required to break even. The number of units required to break even. We are going to be checking on it right like that. So nakuja nachukua formula yangu hapa. I say 0 is equal to the contribution margin X minus F. And I say make my X the subject. Make my X the subject. So inamaanisha if I have to take it on the other side. Divide here by CM, divide here by CM. Very simple. So your X should be equal to F over CM. The number of units required to break even. The number of units required to break even. That is how you normally work out. Done? Are we done? Am I speaking to someone?
Yes.
Now I want to have an illustration in regard to that. So ka illustration kadogo, ka simple product, whereas we are not going to be getting it in an exam, but I just want to connect you, right? The advanced level. I want to connect from the lower, from this lower level to the advanced level. Today my ladies are not talking. I don't know why. Wananiongelesha alafu nikiwauliza hawananyamaza. So we are being told here, we are looking on ka illustration kidogo. Illustration there. And we say a company produces and sells, a company produces and sells a single product. A company produces and sells a single product. So the selling price is expected. The selling price is expected to be 500 shillings. And the variable cost to be Kenyan shillings 300. To be 300 shillings. The fixed cost is expected. The fixed cost is expected to be Kenyan shillings 720,000. 720,000. The company also expects to sell how many units? 800 units. 800. Let me talk about. Let me look on how you can sell. How many units can you be able to sell? The company expects to sell 5,000 units. 5,000 units during the period. Continuing saying, required number one, calculate the number of the units, required to break even. The number of units required to break even. Number two, calculate the margin of safety. Calculate the margin of safety. Now, in this case, I just want to start with solution here. I just want to give you some solutions. So calculate the number of units required to break even. Nakuja hapa nasema vizuri, X is equal to F over CM. So my F is the total of fixed cost, which is Kenya shillings, 720,000. Contribution margin, we are going to be taking the selling price minus variable costs. So my selling price in this case is 500 units, is 500 shillings, minus my variable cost, which is 300. And I'm going to be getting 200 units, 200 shillings, sorry. So to get our X, I just need to take 720. I divide by 200. How much it is? How many units? How many units? How many units?
$3,600.
3,600, correct? 3,600 units. I think we are together to that point. Then number two, the examiner is asking you about the margin of safety. Are we okay, Eunice? To get our margin of safety, we say this is the excess. Is the excess sales above break-even sales. I've said the margin of safety, just like we are discussing about, out of that 600, how many units are they going to be giving us profits? Now, in this case, you just say this. The margin of safety, the examiner might be giving you these conditions. The examiner might be giving you budgeted. We talk about projected. We talk about expected. We also talk about average. Average, do we have current, expected? I think I was able to capture everything, or average. So they are going to be using all these names. They're going to be using all these names. Then you subtract your break-even point, break-even units. So in this case, when we look at it, the examiner, the company also expects, they have given us expected sales, right? Which is 5,000. Minus 5,000 minus the break-even, that's 600. So it means in this case, the break-even, the margin of safety in units is 1,400 units. 1,400 units. 1,400 units. So kama umeulizwa margin in safety in Kenya shillings, you just need to take the margin of safety units, 1,400, times the selling price of ours, which is 500. Which is 500. So this is equivalent to around 700,000, I think. 700,000. Someone to confirm the answer? I don't know. Whether it's 700,000. Hata hapa kwa break even in shillings, you take your break even units, which is at 600, multiply with the selling price. Your selling price is 500. So in this case, Kenya shillings, here we are getting how much? 0.18. I don't know whether it is 180. 180,000. 180,000. Are we together? Eunice, mambo.
1,800,000.
Baba,
I'm following.
watoto wamekimbiza mpaka uongee. Eunice.
1,800,000.
The other one is okay?
Yes, 700 is okay.
Maybe if I can be asked, I can say, I can stand at that point. And then the next time we are meeting, we look on the multiple products. Multiple products. Nasikia mgongo yangu imechoka. Very tired. Request whether we can stand at that point. We are not far from completing. Kwanza hii ikiisha, we are done with this thing. Hii topic ikikwisha ndio refu imebaki. And nothing much is remaining. I will push to make sure that the syllabus is done. This week we are discussing this week.
So nakutana next week.
We might be having a class on Thursday. On Thursday and Friday. Friday we can have classes. I will try to taangalia mambo venye iko. Is it okay?
Yeah.
Usikose.
Sikose niko imara kabisa.